This is where we break down the complex financial stories for you. Today we're tackling a big one, a real industrial heavyweight in Turkey, EREDLİ Demir ve Çelik Fabrikaları. Most people just know them as ERDEMİR Group or EREVL on the Borsa.
That's right. And our mission today really is for you, the individual investor. We're going to dig into their consolidated financials for the first 9 months of 2025. The 9M 2025 numbers. Because honestly, there's this strange situation happening. We need to cut through the noise and figure out why you've got this, well, paradox, serious operational problems, but at the same time, surprisingly strong financials in some areas.
A paradox. Okay, I like that. Let's start simple then. What exactly is the ERDEMİR Group? It's more than just one company, right?
Oh, yeah, much more. Think of it as the main company, ERDEMİR, plus all its consolidated subsidiaries. It was founded way back 1960, been listed on Borsa Istanbul since '86. They're officially based in Ataşehir, Istanbul, but their operations are all over.
And their main job, steel, right?
Primarily, yes. Iron, steel production, alloyed, non-alloyed. Also things like coal and the byproducts from that whole process. It's integrated steelmaking, really fundamental to Turkish industry.
Okay, and you mentioned subsidiaries. Who are the key players within this group structure?
Right, it's kind of an ecosystem. The big one for integrated production is İzdemir. That's İskenderun Demir ve Çelik. Very important. Then you've got Ermadin handling their iron ore and pellet needs, securing the supply chain.
Makes sense. Control the inputs.
Exactly. And Ersem handles the distribution side, the steel service centers. They're even into renewables now with Erdemir Energy.
Renewables too.
Interesting. And they have international arms too. Erdemir Romania for electric steel and Erdemir Asia Pacific out in Singapore doing commercial stuff. So yeah, it's a global footprint.
Got it. So who pulls the strings? Who's ultimately in charge here, governance-wise?
The top parent is Oyak, Ordu Yardımlaşma Kurumu. That's the ultimate owner. Directly, the biggest shareholder is EREDLİ Holding. As of September 30th, 2025, they held about 49.5%. Actually up slightly from the end of 2024. Looks like they bought a few more shares.
Okay, nearly half. What of the rest? Public shares.
Yeah, the public float is pretty substantial, around 46.5%. So, while Oyak has control via EREDLİ, there's a lot of it traded publicly. It's quite liquid.
Let's look inside the company a bit. What about the people? Personnel numbers stable?
Yeah, pretty stable. The total count was 12,369 employees at the end of September 2025, basically unchanged.
Okay, but I saw something in the notes about management pay that jumped out. Seemed like a big increase.
Ah, yes. That's definitely worth noting. The short-term benefits, think salaries, bonuses, that sort of thing for senior management, well, they went up quite a bit. For the first 9 months of 2025, it hit 212.5 million Turkish lira. That's up from about 158 million TL in the same period last year.
That is a significant jump,
Yep.
especially, considering the high inflation environment, more than just keeping pace.
Exactly. It's a pretty large nominal increase. Definitely something to keep in mind as we look at the overall profit picture, which wasn't quite so rosy.
All right, perfect setup. Let's move into that operational performance now, phase 2. This is where things get, well, complicated. Starting with the top line, revenue or hasilat?
Right. So if you just look at the headline number, total revenue seems kind of flat. It was about 147.9 billion TL in 9M 2025 compared to 148.9 billion TL in 9M 2024. A slight dip in TL terms.
Flat. But in a high inflation context, flat isn't really flat, is it?
Precisely, that's the key point. In an environment with very high double-digit inflation, flat nominal revenue actually means your real sales volume or your real pricing power probably went down quite significantly. So the seemingly stable number, it's actually masking underlying weakness.
And where did that revenue come from? Domestic versus international?
Good question. Domestic sales actually fell. They went from 113 billion TL down to about 107.4 billion. But international sales picked up some of that slack. They rose from 27.8 billion TL to almost 32 billion TL. So they managed to export more, but it wasn't enough to drive real overall growth.
Okay, so the top line is already showing some strain. Now let's get to the really stark part. The margins. Profitability. This sounds like where the main story is.
Yeah, this is where the picture gets pretty grim operationally. The gross profit took a major hit. It fell from 17.6 billion TL down to just 11.8 billion.
Ouch.
But the real shocker is the operating profit, the İsas Faaliyet Karı. This is the core measure of how the actual business is doing. It absolutely collapsed, plummeted from 15.8 billion TL last year down to only 5.9 billion TL this year.
Wow, that's, what, less than half, almost down by two-thirds.
Almost exactly two-thirds gone.
Oh,
Yeah,
man.
it's a dramatic fall. This figure really tells you the core operations were under immense pressure.
What drove such a massive decline? Was it just costs going up everywhere, or was there something specific hitting them?
Well, costs did rise. Personnel, energy, manufacturing costs, all up. But the severity, the sheer scale of the drop points to something more specific mentioned in the notes. It's note 13, working portion expenses. These are costs linked to production stoppages, planned or unplanned.
Stoppages, like factory downtime.
Exactly. And those costs just exploded. In 9M 2024, it was under 300 million TL, manageable. In 9M 2025, it shot up to over 1.5 billion TL.
Whoa, a five-fold increase.
Yep. A five-fold jump in costs from just downtime. And critically, that cost gets booked directly under cost of sales. So it just smashed their gross and operating margins.
So it wasn't just market conditions, it was internal operational disruption hitting the bottom line hard.
Very hard. That's a huge operational drag they seemingly couldn't avoid.
Okay, so you have collapsing operating profit. What happens when that flows down to the net result, net profit for the period?
Predictably, it's also way down.
Yeah.
Net period profit crashed from 11.3 billion TL in 9M 2024 to only 2.5 billion TL in 9M 2025.
Just 2.5 billion left.
And for you, the investor, the most direct impact is seen in earnings per share, EPS. That figure tells you how much profit is behind each share. It dropped from 1.60 TL per share last year to just 0.34 TL this year.
0.34, that's brutal.
It really is. Think about it. If the share price stayed the same, the PE ratio based on these earnings would have jumped almost 5 times. You're paying way more for much less earning power compared to last year. It's a stark indicator of a poor operational year.
Okay, that paints a really tough operational picture. But you mentioned this paradox earlier. So let's shift gears. Phase 3. Financial health, debt, cash flow. Is this where the good news is hiding?
Well, before the good news, there's still the cost of financing to consider, which also went up.
Right, financing expenses. How do they look?
They climbed. Total financing costs rose to 11.5 billion TL from 9.2 billion TL year over year. And the main culprit here was the exchange rate impact. The net foreign exchange loss, kurfarkı net, it really spiked. Went from about 735 million TL last year to 2.2 billion TL this year.
Because of their foreign currency debt, I assume. The weak lira makes USD debt more expensive in TL terms.
Exactly. And their debt is heavily weighted towards US dollars. Let's look at note 7. Total borrowings did increase nominally up to about 146.8 billion TL by September 2025 from 121.3 billion at the end of 24. And yeah, over 104 billion TL of that total debt is denominated in USD.
Wow, that's a lot of exposure. What kind of rates are they paying?
The fixed USD loans are actually at a decent rate, relatively speaking, around 7.8% weighted average. But like you said, the lira's depreciation makes servicing that debt very expensive in TL terms. Their fixed TL loans, on the other hand, have a much higher average rate, about 47.2%. So local borrowing is costly too.
Okay, so rising finance costs adding to the pain. Now can we get to the positive surprise? The cash flow.
Yes, now for the twist. The cash flow situation is, frankly, astonishingly good. Cash generated from operations absolutely surged. It went from 12.7 billion TL in 9M 2024, wait for it, to 47.2 billion TL in 9M 2025.
47 billion. From operations. How is that even possible when operating profit collapsed? Where did that cash come from?
It wasn't from profit, that's for sure. The driver was a massive positive swing in working capital management. We're talking about a 34.7 billion TL positive adjustment from changes in working capital.
Okay, break that down. What does a positive swing in working capital actually mean in practice? What were they doing?
It means they were incredibly effective at turning other stuff on their balance sheet into cash very quickly, likely drawing down inventory levels, maybe selling off existing stock, and crucially, being really aggressive in collecting money owed to them accounts receivable, tightening credit terms, getting cash in the door faster, basically prioritizing liquidity generation above almost everything else for that period, financial housekeeping on a grand scale.
So they squeezed cash out of the system. And the result? Their actual cash balance must have shot up.
Shot up is an understatement. It nearly doubled. Their cash and cash equivalents reached 97.7 billion TL by the end of September 25. That's up from $55.2 billion just 9 months earlier at the end of 2024.
Almost 100 billion TL in cash. Incredible.
And here's the kicker. Because that cash pile grew so much, even though total debt went up nominally, their net debt actually went down.
Net debt, so total debt minus cash.
Exactly.
Yeah.
If you calculate it, net debt fell from roughly 66 billion TL at the end of 2024 to about 49.1 billion TL by September 2025.
So despite operational struggles, they actually deleveraged on a net basis.
Yeah.
It's counterintuitive.
It absolutely is. It shows significant balance sheet strength and improved liquidity. A powerful signal that completely contradicts a story told by the income statement. This is the paradox.
Okay, that income statement versus balance sheet tension is fascinating. Let's dig into the balance sheet movements a bit more in phase 4. Specifically, equity. It went up too, right? But not necessarily from profits.
That's right. Total equity attributable to the parent company saw a big increase. It rose to nearly 280 billion TL from about 237 billion. But, and this is crucial, that increase wasn't driven by the tiny 2.5 billion net profit. The vast majority came from something else: foreign currency translation differences. This accounted for a massive 43.5 billion TL gain.
Okay, foreign currency translation differences. That sounds like accounting magic. Can you explain that for us? How is that different from actual earnings?
It's essentially a non-cash paper gain that arises purely from accounting rules. Because EREDLİ's main operations use the US dollar as their functional currency when they have to translate those USD financial statements into Turkish lira for reporting. The depreciation of the lira against the dollar creates this huge positive adjustment on the equity side, reported under other comprehensive income, OCI.
So it makes the equity look much bigger on paper, but it's not cash they earned from selling steel.
Precisely. It inflates the equity number significantly, acting like a big buffer. But it masks the fact that the core operational return on that equity has been severely weakened. It's important to understand it's an accounting effect, not operational cash generation.
That context is absolutely vital, thanks. Now, you also mentioned related party stuff earlier. Did any big transactions there affect the cash position?
Yes, there were some notable related party dealings. Sales to related parties like OAK itself and OAK Renault nearly doubled. Purchases from them also increased. But the really significant item for cash was an asset sale. EREDLİ sold an investment property directly to its ultimate parent, OAK.
Ah, selling property to the parent. How much cash did that bring in?
That single transaction resulted in a cash inflow of 5.6 billion TL. So a nice one-off boost to their cash pile, contributing to that very strong cash position we talked about. Again, financial engineering, not core sales.
Understood. One last check on the balance sheet side. Any major risks lurking in provisions or lawsuits? Could something suddenly drain that cash? Note 8.
Provisions for lawsuits did increase a bit, up to 1.1 billion TL. There was a final resolution on a very old case from 2008 involving Tata Steel International, which required a small adjustment, about 74 million TL. No big deal there. The good news for them is they seem to be consistently winning tax disputes with local municipalities, especially over things like property tax and electricity tax. So the risk of large unexpected cash outflows from those seems low right now.
Okay, good to know. So let's try to wrap this all together now. Phase 5, the investor view. We've got this stark contrast. Operational metrics like EPS absolutely tanking.
Yeah, EPS down from 1.60 to 0.34.
Really bad.
But then you have this fortress balance sheet shown by the huge cash pile and, remarkably, falling net debt.
Net debt down from about 66 billion to 49 billion. Definitely stronger liquidity.
So the big question for you, the investor listening,
Yeah.
what do you focus on? The operational pain or the financial strength? That is the question with EREDLİ right now. It's this classic paradox.
Yeah.
You have undeniable, serious weakness at the core operational level. Those rising costs, and especially those production stoppages, remember the 5-fold jump in stoppage costs. That crushed margins. That's real. But at the same time, you have exceptional financial resilience, that massive cash buffer, the lower net debt, and this huge accounting cushion on the equity from the FX translation.
So when thinking about valuation, EREDLİ's price, how does this play out? We don't have current market prices here, but directionally.
Well, the falling EPS clearly makes the stock look more expensive on a price-earnings basis compared to last year, assuming the price didn't fall proportionally. The improved net debt is a positive for financial risk. But the return on equity, ROE, operationally speaking, must have plummeted. You have much lower net profit against equity that's been artificially inflated by those FX gains. The operational ROE is weak.
So the market has to decide what matters more: balance sheet safety or income statement stress.
Exactly. Is the current price reflecting the balance sheet strength, the cash, the reduced debt? Or is it reflecting the vulnerability of the core earnings power hit by those costly stoppages? If you're investing now, you're essentially betting that this huge financial cushion and the clear skill in cash management are enough to see them through until those core operational issues, especially the costs from stoppages, can be resolved and margins recover.
That really crystallizes the dilemma. And it brings us to our final thought for you to consider. Those huge non-operational gains, the FX translation differences, they dramatically prop up the reported equity figure. But, as we discussed, they fundamentally mask the severity of the underlying operational weakness. So how should you, as an investor, weigh that financial strength, the cash, the FX buffer against the clear vulnerability in the core business, the profitability issues, those damaging
It's
stoppages?
a tough balancing act, financial strength versus operational reality.
Definitely something to think about. That's all we have time for on this deep dive. Thanks for joining us.